If America's debt was truly a problem, you wouldn't need a YouTube video to explain it. You would already feel it. Markets would be panicking, banks would be freezing, the dollar would be collapsing. But none of that is happening. Instead, the US is sitting on more than $36 trillion in debt, and the system looks stable. That contradiction is not accidental, and it's not incompetence. It's the first clue that most people are asking the wrong question. Because the real question is not, how will America pay back its debt? The real question is, why was it never meant to? Most people think about debt in personal terms. If you borrow too much, eventually something bad happens. You either pay it back, default, or collapse. That logic works perfectly for households. It even works for most countries. But it breaks down completely when applied to the United States. Why? Because America is not just another borrower. It is the issuer of the world's primary reserve currency. That single fact changes everything. When the US government spends more than it collects, it doesn't go to a foreign lender begging for money. It issues Treasury bonds, instruments that the rest of the world actively wants to own. Banks need them as collateral. Pension funds need them for stability. Insurance companies need them for regulation. Foreign governments need them for reserves. And this means US debt is not treated like a burden. It is treated like infrastructure. Global finance doesn't function despite US debt. It functions because of it. That's why comparing America's debt to household debt is misleading. A household cannot create the currency it owes. The United States can. A household cannot force the global system to accept its IOUs. The United States effectively can. This is why warnings like, America is maxing out its credit cards sound intuitive, but are structurally wrong. They ignore the system America operates inside. And that system was built after World War II with a very specific design. The US would supply the world with dollars. The world would supply the US with goods, services, and capital. Debt was not a side effect of this arrangement. It was the mechanism that made it work. Every US deficit created new dollars for global trade. Every Treasury bond created a safe asset for the financial system. In other words, debt wasn't a mistake. It was a feature. This doesn't mean there are no consequences. It means the consequences are not obvious, immediate, or confined to America alone. They are delayed, they are distributed, and they are subtle, which is why the system can look stable for a very long time, even as pressures quietly build underneath. If US debt were just borrowing, the system would have collapsed long ago. $36 trillion is not a manageable number in any normal sense. So the reason it still works is simple. US debt is not treated like debt. It is treated like a tool. When the US government issues Treasury bonds, those bonds don't disappear into a vault somewhere. They circulate through the entire financial system. Banks use treasuries as collateral to make loans. Pension funds use them to balance risk. Insurance companies are required by regulation to hold them. Central banks use them as reserves to stabilize currencies. In modern finance, treasuries are considered the closest thing to risk-free money. Not because they have no risk, but because the system is built to protect them. This is why US debt is everywhere. It sits underneath derivatives markets. It backs repo transactions. It anchors interest rate pricing across the world. Remove treasuries, and you don't just remove government borrowing. You remove the foundation that trillions of dollars of private finance rest on. This is the part most people miss. The global financial system does not want less US debt. It wants more as long as it remains liquid and trusted. That's why every major crisis produces the same response. In 2008, when credit froze, the solution wasn't austerity. It was debt expansion. In 2020, when markets panicked, the solution wasn't paying down obligations. It was issuing more treasuries and creating more dollars. Each time the system demanded the same thing: more safe assets, more liquidity, more collateral. And US debt is the only asset large enough, deep enough, and liquid enough to satisfy that demand. This creates a strange inversion of logic. What looks like reckless borrowing from the outside is actually system maintenance on the inside. Deficits are not treated as emergencies. They are treated as inputs. This is why politicians argue loudly about debt ceilings, but quietly agree on expanding borrowing, because the cost of stopping would be higher than the cost of continuing. But here's where the tension begins. If US debt is essential infrastructure, then its growth must be absorbed somewhere. And absorption always has a price. Not paid all at once, not paid equally, but paid gradually through distortions. Low interest rates reward borrowers. High asset prices reward owners. Inflation punishes savers. The system works, but it doesn't work neutrally. And this leads to the next uncomfortable question. If US debt is the fuel that keeps global finance running, who benefits the most from that fuel? And who quietly pays the cost? Because once you follow that trail, you start to see why this system creates inequality, instability, and resentment without ever triggering a visible crisis. Every system has a cost. The The difference between visible failure and long survival is how that cost is collected. America's debt system survives because its costs are not charged like a bill. They are distributed quietly. No invoice, no announcement, no single group to blame. And that's why most people never realize they're paying. Let's start with the most obvious mechanism, inflation. When the US runs persistent deficits, it injects dollars into the system. Those dollars don't disappear. They flow through banks, markets, and asset prices before they ever reach wages. This matters because money does not affect everyone equally. New money enters the system at the top: financial institutions, asset markets, government spending channels. By the time it reaches ordinary consumers, prices have already adjusted. This is why asset owners benefit first, and wage earners adjust last. This isn't theory, it's how modern monetary systems function. And it explains something many people feel but can't articulate: why the economy looks strong on paper, but life feels more expensive every year. Housing rises faster than income. Healthcare outpaces wages. Education becomes harder to afford. Nothing collapses. Nothing breaks. But purchasing power erodes. This is the first cost. The second cost is paid outside the United States. Much of the world borrows in dollars. Emerging markets issue dollar-denominated debt. Corporations rely on dollar funding. Countries hold dollar reserves to stabilize their currencies, but they do not control the policies that govern those dollars. When U.S. interest rates rise, capital flows back to America. Currencies weaken elsewhere. Debt burdens grow heavier in real terms. This is why currency crises often hit countries that did nothing wrong. They are simply downstream from the system. America prints the currency. The rest of the world manages the consequences. This creates a quiet imbalance of power, not enforced by armies, not declared in treaties, but embedded in the structure of finance itself. The third cost is political. As debt grows, governments become more constrained. More spending goes towards servicing old obligations. Less flexibility remains for new priorities. Policy choices narrow. And when policy narrows, tension rises. People sense something is wrong, but can't point to a single failure, because the system hasn't collapsed. It has shifted pressure. This is why America's debt doesn't feel like a crisis. The pain is real, but it is spread thin enough to avoid revolt. And that's the most important insight of all. This system does not survive because it is fair. It survives because it is stable enough. But stability does not mean permanence. Costs that are postponed do not disappear. They accumulate. And when accumulation reaches a certain point, behavior changes. People hedge, institutions adjust, countries seek alternatives, not out of panic, but out of prudence. Which brings us to the next phase of the story. Because when the cost of a system becomes visible, even quietly, trust starts to change. And trust, once questioned, never fully returns to its original form. For a long time, this system worked smoothly, not because it was perfect, but because confidence was unquestioned. Investors trusted the dollar. Central banks trusted U.S. treasuries. Governments trusted that liquidity would always appear when needed. The trust acted like oil in the engine. It reduced friction. It absorbed mistakes. It allowed imbalances to grow without immediate consequences. But confidence is not permanent. It doesn't disappear suddenly. It thins. And that thinning is what we are seeing now. The first sign is not panic. It's hedging. Large institutions still hold dollars, but they hedge currency exposure more actively. Central banks still buy treasuries, but they also accumulate gold at the fastest pace in decades. Countries still trade in dollars, but they quietly build local currency settlement systems. None of this makes headlines because it doesn't look dramatic, but it tells you something important. The system is still trusted, but no longer assumed. That distinction matters more than most people realize. When trust is assumed, the system forgives mistakes. When trust becomes conditional, the system prices them. This is why markets today feel different from past decades. Good news can cause volatility. Bad news can cause outsized reactions. Liquidity can disappear temporarily without warning. Nothing breaks, but everything becomes more sensitive. Higher interest rates are a key reason for this. For years, low rates masked the true cost of debt. Borrowing was cheap. Refinancing was easy. Deficits felt painless. As rates rise, the math changes. Debt servicing costs increase. Fiscal flexibility shrinks. Policy choices become constrained. The system still functions, but it no longer has the same margin for error. This is why governments face harder trade-offs. Support growth too aggressively and inflation returns. Tighten policy too much and growth slows sharply. There is no painless option anymore, and markets know it. This is also why global capital behaves differently now. Money moves faster. Positioning is more defensive. Risk tolerance is lower beneath the surface. Not because investors expect collapse, but because they sense fragility. Fragility does not mean failure. It means the system reacts more strongly to stress. A resilient system absorbs shocks. A fragile system amplifies them. And fragility often looks like calm until it doesn't. This is the phase where systems change without announcements. No reset button, no dramatic event, just a gradual shift in behavior. And behavior is always the first thing to change. Because once participants stop believing the system is effortless, they start preparing for outcomes that were once unthinkable, not abandoning the system, not revolting against it, but adapting to it. And adaptation is how transitions begin. At this point, it's important to be very clear about something. This story is not about collapse. It's not about the dollar suddenly failing. It's not about the US defaulting. And it's not about a single dramatic moment where everything breaks. Systems like this don't end that way. They evolve. America's debt system is not designed to explode. It's designed to roll forward. Debt matures. New debt replaces old debt. The system keeps moving. What changes is not the existence of debt, but the conditions under which it operates. For decades, the U.S. benefited from something economists politely call exorbitant privilege. America could borrow cheaply, run large deficits, expand its balance sheet, and the world absorbed it. That privilege hasn't vanished, but it is no longer automatic, and that distinction matters more than any headline. When borrowing becomes more expensive, even slowly, choices narrow. More government revenue goes toward interest, less goes toward flexibility. When markets become more sensitive, even quietly, mistakes matter faster. Policy errors that once faded away now leave marks. This doesn't show up as chaos, it shows up as friction. Slower growth, more volatile markets, less tolerance for imbalance. The system still functions, but it stops forgiving. This is why many people feel uneasy even when data looks fine. Unemployment may be low, markets may be near highs, the dollar may still look strong. But strength under pressure is different from strength by assumption. The dollar no longer operates in a world where alternatives don't exist. They may not be better, they may not be dominant, but they are available. And availability changes behavior. When participants know there are options, even imperfect ones, they behave differently. They hedge more. They concentrate less. They demand compensation for risk that was once ignored. This is how power shifts in modern systems, not through rejection, but through optionality. The US doesn't lose relevance overnight. It loses effortless dominance, and that changes outcomes gradually, not suddenly. For individuals, the lesson is not fear. It's understanding. Understanding that nominal numbers don't tell the whole story. Understanding that stability and fragility can coexist. Understanding that systems rarely announce when their rules change. Those who wait for confirmation from headlines are always late. Those who understand structure adapt early. And that's the final truth about America's debt. It is not a problem to be solved. It is a system to be understood. Because once you understand how the system works, you stop reacting emotionally to numbers and start seeing where pressure builds, where incentives shift, and where the future quietly diverges from the past. History doesn't repeat itself perfectly, but it always rhymes. And the rhyme right now is not collapse, it's transition. If this video changed how you think about debt, inflation, or the dollar, leave a comment with the word system. I read them. And if you want more breakdowns like this, subscribe and stay with us.